Thank you all for joining us for our next discussion, a Build for Rent Outlook, which will focus on how the Build for Rent model will respond to recent market conditions. We've got a stellar lineup to address the topic, and I'll hand things over to Kevin after a couple of short reminders. For those of you that aren't familiar with Zoom functionality, there's a Q&A button at the bottom of your Zoom window. Please do put your questions in there throughout the discussion. Kevin will keep track of that, and we'll leave 5 minutes at the end of the 5 minutes or so at the end of the discussion to go through your questions. You can upvote these, and the most popular ones will be prioritized. Please also do make use of the chat function in your Hub browser. You can switch between the Zoom window and your Hub browser, and you'll still be able to hear everyone in Zoom. This chat function will allow you to message other attendees. You can click on their name to message them privately. And then lastly, in about, I think, 15 minutes time, an evaluation section will appear in this Hub, in your Hub window as well, which will allow you to leave comments or suggestions for future discussions. And we really would appreciate it if you could take part in that. Without any further ado, I'd like to hand things over to Kevin Stuckey, who's a Senior Vice President of Development at OneBridge Group. Thanks, Kevin. You're on mute, Kevin.
I'm here this morning with several of our cohorts in the build to rent sector. I'll ask each of them to introduce themselves in just a second. Eric Matheis is with Pentar Investment. Michael Finch is with SVN. Jim Driscoll is with Transcendent Investment. And Patrik Sharma is with Bridge Tower Partners. I'm the Senior Vice President of Development with the OneBridge Group. We're a vertically integrated building and development company based in Houston. We build and develop here in Houston and also in the Dallas market. Currently, we have several projects underway and are enjoying, I think, like most everyone else, enjoying the status of the build-to-rent market. If I can ask each one of you guys, Eric, if you'll introduce yourself and tell us a little bit about your company, I would appreciate it.
Absolutely. Thanks, Kevin. Eric Matheis. I'm an asset manager over at Pentar Investment Company. We're focused at targeting and kind of build-to-rent communities located in opportunity zones and a few select markets around the country.
Good deal. Michael Finch, tell us what's happening at SVN.
Thank you, Kevin. Michael Finch here, principal founder of SVN SFRhub Advisors and our SFRhub related companies.
Good deal. And Jim Driscoll. Need to unmute you, Jim.
Let me start that again.
There we go.
Good afternoon. Jim Driscoll, Executive Director of Acquisitions and Asset Management for Transcendent Investment Management. We are a vertically integrated owner, operator, and developer of both what we call scattered build for rent and purpose-built build for rent communities across the Sun Belt mostly, although we are expanding across the nation over the coming years.
Good deal. Good deal. Patrik Sharma. Tell us about Bridge Tower.
Thanks, Kevin. Yeah, this is Patrik Sharma. I'm Managing Director at Bridge Tower. Bridge Tower is a vertically integrated single-family rental housing asset management company. We have 1,700 houses across Dallas, Houston, as well as Charlotte.
Good deal. Good deal. Well, let's jump in. The topic today is a build-to-rent overview, and Will the model have some unexpected twists and turns during the recent market conditions? I think it's safe to say the market will have some twists and turns no matter what happens, but certainly within the recent months and the different changes in the market conditions. One of the things that we have talked about a little bit is the impact of the coronavirus on the market. I'm all in favor of it. No, but that if somebody else offer some insight there, I would appreciate it.
Yeah, this is Jim Driscoll from Transcendent. I think it really starts, 10 years ago when we entered the Great Recession, and we saw at that point in time the constraints on the ability for people to purchase single-family homes and the need for a continued evolvement of the multifamily space. And then as the millennials continue to mature alternative types of housing that would include single family and townhome rentals. I think the great news for those of us in the space is that this feels like a 2.0 opportunity, as the COVID impact has further caused people who were planning to move into single family or townhome rentals to accelerate that decision. So, and as you said, the only certainty that we know is that things will change.
That's true. Eric, can you see what's happening out there on the West Coast in your investments? What's happening with the impact of the COVID virus?
Yeah, absolutely. I mean, I think, at the end of the day, like, kind of Jim was saying, we have a very resilient kind of product and asset class here in kind of the single family build to rent kind of space. But, kind of at the onset of the pandemic, really, in kind of, late March and early April, we saw kind of a, end of the world kind of feeling amongst a lot of the partners and kind of builders that we're kind of working with. I think, specifically builders kind of reaching out that were in the middle of some subdivision developments, kind of looking for, can we kind of find a takeout partner in case, things really hit the fan in an unexpected way. But I think in the past, kind of 5 months, I think have began to, I guess for lack of a better term, normalize a little bit. We haven't quite seen a, kind of quote unquote crash landing of this. I think that's attributable to, like I said before, the resilience and kind of, the product type single family home is being essential, because at the end of the day, people have always needed a roof over their heads, and they're all going to continue to need a roof over their heads.
I think that's good insight. We have, I think the immediate reaction from many lenders and builders were to pull the brakes on, and then we all realized that from a multifamily standpoint, that they were coming, those same tenants were coming to us rather than away from us, and it certainly changes our world. Patrik, what did you see in your markets?
We've seen. Our experience has been typical of, or similar to, the publicly traded builders, in that our collections rates are exceeding, basically 103% of what they were last year. Demand is it's through the phones ringing. We get more inquiries every single day than we actually have available units to lease out to people. And to echo or kind of just build upon what Jim mentioned earlier, is that there was a lot of trends that were in place pre-COVID. Primarily driven by demographics, and those trends have only accelerated, given the nature of the pandemic, the response to the pandemic, and just the palpable sense of uncertainty that exists everywhere. People kind of just want to be in their own space and have some space to walk around and that sort of thing. And that's great news from the demand side.
Very good, Michael. And I'm sure you're looking at things from a 30,000 foot elevation. And
yeah, and I'd echo everything that everybody said. I mean, from our data and our brokerage companies, we're seeing, just everything that we expected to see. Just strength through this particular situation in the SFR and BFR market. And to Jim's point of the single family rental world coming out of the last recession, I mean, even to add to that, I'd say the demographics were changing before that, and now we've seen two strong reasons why it's such a good asset class. I mean, when the run up in single family homes was happening pre-recession, those that could get in were getting in, but so many were being outpriced and having to rent anyways. And then the recession hit, and the rental market exploded, and now here again it's been proven to be a very strong risk mitigated asset class.
I was talking to my father, who was a builder for his career. He's 92 now, but he was telling him what we all are experiencing around the country as far as the demand, and he said that reminded him of the post World War II building boom, that you just couldn't put them on the ground fast enough, and that it's kind of a good problem to have.
They were building for rent back then too.
Yeah, that's true. That's true. For many of the same reasons, the affordability, the people that had the down payment were few and far between. In looking at the acquisition approach and how people are accumulating any kind of portfolio or building their portfolio, what are you guys seeing as far as approaches to that? Are there joint ventures with builders? Are you acquiring, or people simply acquiring through builders? You know, Michael, what are you seeing happen in the world there?
The typical way we've been seeing it happen is acquiring directly from builders. You know, in a pre-commitment tranche takedown schedule. You know, where the capital, you know, underwrites and you know, puts a pro forma together, and we typically assist with a lot of that work, and then, you know, bring that together with the builder. You know, maybe there's some adjustments to the finish level, but, you know, getting an agreement on a price per home with the builder, and then a deliverable schedule from the builder as to, you know, can you build and deliver 10 homes a month at CO, 15 homes a month at CO, and then, you know, moving through the transaction like that. But, you know, some of the other, you know, guys on this table are certainly working other creative ways, and there's other groups out there that are bringing, you know, equity to the dirt, you know, taking on some of that development and construction risk to be, you know, pregnant in the deal and be the takeout buyer. That's a successful way of doing it and answering and solving some of the concerns that, you know, builders typically have of buyers that may or may not perform, which is always the same concern that a buyer has if a builder, you know, doesn't perform.
Absolutely. Patrik, are you seeing any different approaches? You've been pretty busy in what you guys have been doing.
Yeah, so I mean, we're slightly, you know, I guess unique in that we have an in-house construction team, right? So to achieve the return targets that we're, you know, shooting for, doing, you know, vertical, you know, doing either partnering with somebody to do the horizontal land development and doing the vertical construction ourselves, or as Michael mentioned, you know, looking at potential opportunities to take down supply from some of the, you know, regional, national home builders. Those are ways we're looking at it. You know, this is one of those, I guess, you know, to kind of like a tale of two cities, or is this Dickens or Shakespeare? But it's like, you know, it's the best of times and the worst of times. So we have a bull market in single family rentals right now. We also have a bear market in just brains. And so what we're seeing is just deals being taken down, especially in quote unquote hot cities, at numbers that make no sense, or the deals are so skinny that there's little margin for error. And anybody who's been in this business for more than 30 minutes and has at least a few gray hairs knows that you need to have some margin for error. So I'm not seeing a lot of that right now. So yes, you know, you want to rush in, you know, eyes wide open. This is not one of those blindly kind of start just writing checks and see what happens. Yes, the demand is there, but I think it's really a function of a lot of different things that, you know, if you dig a little bit deeper, you'll see that caution and prudence will be rewarded in the years ahead.
Sure. Hey, Jim, from an investment perspective, are you seeing a product fit a demographic profile specifically, or is it just generally whoever's there to lease from you?
Yeah, I mean, you know, it's, you know, first going back to what Patrik was talking about, you know, our approach is really a two-pronged approach in that we look at both the, what we call scattered BFR, where we're buying existing inventory, either on a quick delivery basis or a programmatic basis from both the national and the regional home builders, as well as building our own purpose-built build-for-rent communities. You know, and so that two-pronged approach helps us, you know, achieve our investment goals. And as Patrik said, you know, when you look at some of the cap rates for where some of the existing build-for-rent communities have traded for, they're now actually trading in line or in some cases even below traditional multifamily cap rates. So obviously the going in land pricing, you know, can be constraining. From a demographic perspective, you know, we talked before about the millennial. You know, the oldest millennial is now 39. And so the opportunity for them to have a home, we know that they're forming families older. So the opportunity for them to have a home so that they don't have to push Johnny down the carpeted corridor of a multifamily building with his big wheel, or tell Susie to go down the elevator, go past the concierge and go out and play in front of the building. You know, so the opportunity to have either a single family home or even a townhome something that has a driveway, a door, and some sort of semi-private or private outdoor space is important. That's one renter profile. And I think the millennial, because they've gotten so used to renting for so long, that the lock and leave culture, that for many of, those of us who are in the industry who are, 20 years older, never lived that lifestyle. We rented for 5 years and then we bought a home. Millennials have already rented for 10 before they've even started to form a family. And so the idea of the American dream for them may be, in fact, the opportunity to be flexible, which is obviously what you get with a single family rental. The other cohort obviously is the other barbell, which is the baby boomer, who's looking to move down, and they've had the opportunity to have achieved significant capital appreciation in home ownership through the 80s, 90s, and early 2000s. And they may be looking for the ability to both take money off the table as well as have the flexibility that the millennial is looking for with a lock and leave culture.
It is interesting. We have seen about 85% of our tenant base is in the millennial category, and the other 15% is the baby boomers who are saying, I want to live in a house. I don't want to live in an apartment, but I do want to be able to lock the door and walk away on the weekends and enjoy that. So let me shift gears a second to financing. Eric, what kind of financing structures are you using for acquisitions or hold, either way? But what kind of financing structures are you seeing out there?
So what we've done, essentially is I think maybe backpen a little bit to what would be useful to kind of give a little bit of insight on kind of structure and the way we've taken down a couple of these build-to-rent deals. I think we're pretty flexible. I think the biggest thing for us is just to avoid land entitlement risk. We're not a vertically integrated builder or developer, so we kind of stick to what we know. I think we try to partner with other groups and builders where we can kind of take down finished lots and then kind of engage them to kind of GC the homes on a separate construction contract. So there's certain structures that we've replicated a couple of times where we kind of take down the homes on a phased basis prior to C of O to kind of stay opportunity zone compliant, and then we'll kind of put a kind of bridge loan on those assets until we can kind of stabilize them. And then once we're able to stabilize that portfolio, we'll go out and try to find some perm debt on it, kind of depending if the community can mark or kind of check all the requisite boxes for the agency financing. That's something that's really attracted to us. And we're kind of, continuously learning and try to tailor our communities to kind of fit that mold. But then that's kind of really the structure we've gone with on a few of our acquisitions, just that kind of bridge loan, kind of roll it over into perm debt.
Patrik, are you seeing, is financing readily available? Is out there? Or are you having to hunt for it?
The answer to that's real simple. It's a yes, absolutely. Financing is readily available. There's no shortage of financing out there. I mean, look, build to rent and single family rental housing went from a little known, subsector of the hard assets or real assets asset class pre-pandemic, and now it's the worst kept secret on Wall Street, right? So, and this is why you're seeing, cap rates compressed. You're seeing, people are throwing money at potential projects. And, when I see something taken down, not even in Austin proper at a 4% cap rate, I'm like, whoa. So yeah, is there financing bill? Absolutely. It's how many homes can you deliver? How many lots are there out there? I mean, right now, probably the most popular guy in Texas is the oldest dirt dog out there. So let's see. The issue is not financing by any stretch of the imagination. Sure.
Michael, in looking and looking for financing, if an investor is seeking financing, are the traditional lenders in the business, or is it a whole different source?
Yeah, I mean, as Patrik said, the challenge is in financing. We've got a number of alliance members through our brokerage company, lenders that are playing in the space. We worked very closely with a few, and anyone that's listening, we've got assembled a team with Walker and Dunlop that's put together an incredible financing package from A&D to construction financing to bridge loan financing on the takedown and rolling that into permanent financing on the back end at stabilization. So, it's all there. A lot of opportunity.
Got it. And shifting gears to design and amenities, I will tell you from our perspective, from a builder designer perspective, we have everything in-house. We've seen some pressure to deliver, from pressure from our tenants or interest from our tenants to have workspaces in houses that were not included previously, not included 2 years ago for sure. Are you guys seeing that as well, Eric? Are you seeing that in your product?
I think one of the underlying kind of forces and kind of demographic changes is, the fact that, I think COVID has kind of accelerated that work from home trend 5 to 10 years. And so people are coming, kind of looking for single family homes with the intent of, maybe it's a, 4-bedroom house where you have, two mom, dad, and a kid, and you can kind of utilize that extra bedroom as an office space. And so we're absolutely seeing that across our portfolio. A lot of our kind of tenants, we actually went through a lease up at the onset of this pandemic. So kind of, kind of everything happened, held our breath, and then it's kind of just been, a surge from there. And so absolutely, I think a lot of our tenant base and demographic is kind of shifting from, the more kind of dense urban multifamily kind of demographic and kind of coming out into the suburbs where they can get that, extra bedroom, they can get that yard, they can get all the things that they're looking for, that they can't get in that multifamily kind of unit.
We've seen that as well in the push to the suburban areas. Even with a larger house,
right.
Moving up to 2,400 square feet, 2,600 square feet, which has been a real eye opener for me, because I think traditionally you look at the rental market, I think the general mindset was low end, and that's no longer the case in our market. Jim, are you seeing that as well?
We are. I think there's two things going on. I think the reality for a long time was that a large percentage of the workforce was working from home anyways. In the traditional multifamily space, most people found about 10 to 20% of their tenants were gig workers, consultants and alike that were working out of their apartment. And so they were just trying to work within the space that they had. I think one of the things that's happened as a result of COVID is that people have gone from adapting rooms to a work and home environment, to creating spaces that are unique, understanding that kind of the curtain's been pulled back, and that, the 10 to 20% is now a much larger percentage and will likely remain that going forward. And the need for that is important. One of the other things that we're focused on in conjunction with the work from home environment is the health and wellness concept, which we think is a critical component for the millennial renter. So, providing health and wellness services for the community, from fitness, through, nutritional consulting, through, a whole basket of things, we think is going to be a part of the future, as people are, spending more time in their home and kind of understanding from a holistic basis, what that means to them, both professionally, personally, and their wellness as well.
That's very smart. I think people are looking for it in so many instances. They don't really know where to look, and if the community can provide that, it certainly makes things a lot easier. Let's talk about some latest deals being done. Patrik, do you have anything new that's been on your stove here lately?
Yeah, it's one of those things where I think the best way to describe the current environment between what investors want and what the industry is able to provide, there's definitely a delta there. I think expectations for high 6, 7 cap rates, fully leased up SFR product compared to where the deals are actually being taken down. There's kind of a gulf that's happening over there, and I think it's really a function of a couple different things. The issue is really supply, but supply is being artificially or distorted. I don't want to say artificially. That might set off some cancel culture guys, and so I don't want to go down that road. But what I mean by that is that, like, look, you've got forbearances and foreclosure moratoriums in an election year, right? So I mean, there's no new distressed supply truly coming on the market right now that anybody actually wants, and so that's just pushing prices higher and higher. And at Bridge Tower, our risk management is what we do as asset managers. I mean, yes, we're in the housing industry. We build homes, we lease them up, we service them, we do a full life cycle of all that stuff. But fundamentally, we are fiduciaries of investor capital and our own capital. And when you look at risk management, a quotation by Nassim Nicholas Taleb comes to mind, which is risk management is eliminating the risk of ruin, so you can aggressively take non-ruinous risks, right? And right now, those are fewer and far between. We're able to do some of that stuff just because of our relationships with local developers, our ability to source lots in areas that are kind of in our wheelhouse. But I do definitely see a big delta between investor expectations and what's actually available in the marketplace.
That's a challenge. It's always a challenge. As far as new developments or new projects coming on, Michael, have you seen new projects hitting lately?
Yeah. There's many of them. We've underwritten thousands of homes, just during COVID in the build for rent space. Many of those will likely be coming to market in Q3, Q4. We're negotiating and under contract on a large number of them, which are all scheduled with a buyer to just take down at CO from builders. So the buyers projecting to agree to a certain price, projecting north of a 6 cap at stabilization. To Patrik's point, very challenging to buy a fully leased community north of a 6 cap. That is not, and who wouldn't buy that? You'd be crazy not to, but but you gotta, the savvy guys in the business, they understand development, they understand construction. If you don't know those aspects of the business, it's very challenging to negotiate with a developer builder. You end up making offers that don't make sense. And there were even more of that happened within a month of COVID, thinking that discounts would, miraculously appear, which, take years to form. It doesn't happen overnight. The last recession, we didn't see discounts until 2010, 2011, but the recession hit in 2008. But yeah, I mean, there are a lot of deals being struck out there, and if you negotiate with a builder correctly and you can agree on a price, there are cost savings that the builder can assume. Some of that can be passed on to the buyer, and the buyer takes on that lease up risk. If you're closing in monthly or bi-monthly tranches, depending on the builder's delivery schedule. But we've got a couple $100 million worth of deals going right now.
Good deal. Hey, let me jump over to some questions that have been sent in. We've been asked a question: are you in these properties for the long haul, or are you looking to sell units on a regular basis? Eric, what is your approach on that?
So, our fund's mandate is to comply with the opportunity zone. And so, what that really entails is that you get kind of a, 3-pronged kind of tax advantage investment if you hold, your kind of BTR communities for a period of 10 years. And so if you hold it for those 10 years, you kind of get a tax-free growth on that investment when you go to kind of sell it upon year 10. And so our strategy is, for these BTR communities is a long-term hold that, 10 years at least plus, and then maybe at that disposition date or projected disposition date that we're underwriting, and kind of, talks with our equity, we'll talk about, hey, do we want to go sell it? What's the market like? Is the timing right? Do we want to refinance it instead? But, all in all, it's a long-term hold from our point of view.
Jim, are y'all long-term or short-termer?
So we look at it, two ways really. Traditionally, most in this space were retail sellers. They were selling to, small investors, on a onesie, twosie basis, or in many cases, the tenant became the homeowner of the property. We've started to transition our thought based on the interest in the institutional market from a retail seller to a cap rate seller. So we tend to look at the acquisition of homes on a yield basis, understanding, what the likely cap rate is going to be for that property 3 years out. We think 3 years is a good hold period as it relates to, it's still a new product. it's still got little or no CapEx requirements. And so the buyer that's taking it is virtually buying a brand new home, in a, fully amenitized brand new community.
Good deal.
I think to add to that too, just on the cap, sorry to cut you off there, Kevin, but there is, even though they don't own it, there is a sense or a pride of ownership for a lot of these residents that are moving in. I personally think because they are young families, they are establishing themselves, or they are baby boomers, who like to take care of things and are used to taking care of things, but now they don't have to because they can call the landlord. But 3 years, no CapEx, very achievable with the type of renters that are moving in to build for rent homes. I mean, these are affluent people that take care of their lives, that take care of their children, their families, and are going to want to take care of their home.
That's a very good point. You touched on it because there's so much construction, and as Patrik mentioned a little while ago, as soon as the house is finished, we're moving people into them. We found we've had to train our leasing people to work with that tenant, get that tenant committed, but allow them to see the house being built. Allow them, we'll walk them through on occasion during construction. We don't necessarily need a big parade of people interrupting the construction process, but we do welcome those tenants in. Your point's well made, Michael. They see that as their home, and that's there's not financial ownership necessarily, but there's emotional ownership for sure.
Well, Kevin, I think kind of echoing one of Jim's points earlier is that the American dream hasn't disappeared. It's just the acquisition structure has probably changed a little bit. We actively nurture the community feel within our BTR communities, and our communities, we really focus on the entry level client base. So I don't think it's actually a class or an income level thing. It's actually just people, especially in this environment, really crave the concept of community and connection.
Mm-hmm.
And that's a human factor. That doesn't change whether you're in the US or in Europe or South America or wherever.
There's another question on here. If it weren't so serious, I wouldn't think it's so funny. They ask about when looking into an area for developing, for building for rent, how do you find and acquire land to develop? The answer to that is any way you can. We work very closely with a relatively small network of brokers, but they specifically are land brokers. Because we have found that they are the most knowledgeable, most well connected. Not an easy task in the Texas market these days.
Very challenging.
This is real.
Very challenging, and I appreciate you mentioned brokers because that's the name of our business. But being that SFRhub is part of the SVN platform, we can, especially for the guys looking for the dirt, we can refer out to our land specialists in different markets to help source those land opportunities, which, as Patrik knows, in Texas is not easy to come by. But they're out there. If you've got the right land brokers and they have the right relationships with the developers, they will know where the deal is before most people.
Yep, very, very true. Eric, there's a question about building in California. There's a question about buying and developing or building in California. Do you have any planned deals on the horizon?
We are actually looking at a couple of things in the Los Angeles market. It's not so much your traditional kind of single family build to rent, kind of how we're talking about on this panel right now. It's more so kind of your residential, maybe 50 unit kind of adaptive reuse apartment kind of deals. But we're not doing ground up construction, acquiring and sourcing land and doing the BTR approach here. It's just too expensive in California. I think from we're looking at it at an all in per unit basis, and we're finding these things penciling or these communities penciling. You got to be around, under the 220 all in number to keep up with the rent. And in the California, specifically Southern California, kind of where we're located, you don't get the same kind of appreciation in rents as you do in the value. And so you can't, it doesn't quite pencil at a, $800,000 per house and, $3,000 in rent. And so we're not looking to, kind of deploy that strategy in California as we are in other markets across the Sun Belt and the Southeast.
Good point. There are a couple of questions about design topics or design questions, and one about, is anybody incorporating soundproofing or movable walls or Murphy beds or anything like that? Another question with the work from home space, are we separating that space from a play area or something like that so it can be quieter where somebody could actually work from home and not necessarily be interrupted by the family? Are you guys seeing any design changes like that or design implementation like that? Eric or Patrik, are y'all seeing that in your products at all?
So the quick answer is there are design changes that are directly attributed or a function of the work from home or the thrust or the surge in demand for work from home options. From a design perspective, are we putting sliding doors or Murphy beds? Like, again, we're building an entry-level product and we want to give the actual tenant, the resident, as much flexibility to do whatever they want to do. So some people like yoga. I'm not building a yoga studio inside everybody's house in my BTR community. So what we're really focused on over here is giving people the tools to kind of have the ability to do what they want in their own home. That's the freedom and flexibility you get in a single family rental. And I think the biggest key, at least for me, and maybe it's because I'm a nerd or something like that, is just internet speed and bandwidth, right? So when you've got adult 1, adult 2, child 1, child 2, all on simultaneous Zoom calls, if you're not running fiber through those homes, you're gonna have it's gonna be challenging. Let's just put it that way. Mm-hmm. And then you put in 7 Apple TVs and iPads and all the smart devices out there. I mean, we just basically, you need those pipes to be big. And you really need that data bandwidth. And I think that is probably, if I had to choose between a place that was wired with Cat6 fiber, running a gig of speed through the entire house, as opposed to a house that had sliding doors that I could meditate in or use as an office, I'm going with the speed all day, all night.
Yeah, and I think just to kind of echo off what Patrik was saying, in terms of kind of tailoring the product to kind of fit maybe that office kind of space, I think, we're not really making significant changes in the design, the way we're kind of looking at these homes, but at the end of the day, if you're looking at a 3-bedroom, I don't think we want to kind of limit our renter pool by designating one of those bedrooms as an office space and not, having the ability to use that bedroom as you'd like it, whether it be a play area for your kids, whether it be that office space or whether it be, a bedroom. I think, in terms of kind of just attracting the most broad pool of tenant-based people you can, I think that's kind of the way we're looking at it.
Yeah, I mean, I think one of the realities is that, we're obviously all hoping that the COVID experience ends for us. And so, like in the case of my own household, my wife works from home, as an IT consultant, and she has done so for the last 10 years. So she does have a dedicated office. Once I needed one in March, I needed to find a spot within the house that would become my dedicated office. But we certainly didn't have 2 dedicated offices set up initially, and obviously going forward, we're not expecting to do so. So having flexibility within the room spaces, understanding that these homes are generally in the 1,400 to 2,200 square foot range, and generally will include 3 or 4 bedrooms. Obviously having that flexibility is important. But these are micro units, as Patrik pointed out. So the idea of sliding walls and Murphy beds and alike, which is traditional in the smaller traditional multifamily formats, isn't usually a part of what you'll see in a single family or a townhome design.
And I think, Transcendent is I think sort of leading the way in at least from what I've noticed, really taking on that healthy lifestyle approach. But, to your point, the technologies that are coming to market, the advance of ESG investing, more and more people are going to want, environmentally sound homes, energy efficient homes, great Wi-Fi. A lot of this is evolving now, and I think the building industry is going to see a lot of change in the next 5 years. And I know I could speak for some of our staff, but soundproofing walls during COVID would be awfully nice for them to place some of their children in when they're on Zoom calls. Or dogs or whatever that may be. But I think there's a lot. I think there's a lot that's advancing, and those will be interesting options to be able to pass on to build-to-rent communities.
Yeah, that the initial cuteness of that, Michael, got old real quick, didn't it? I mean, it's, I think with respect to building amenities or kind of remodeling design for the COVID environment, yes, you absolutely have to adjust to the market and to the times. But I think prudent asset managers and prudent builders, you don't want to get caught in one of these, where the generals are always fighting the last war. COVID is here. It's a reality in our life. It's going to be with us probably 12, 18 more months from here at a minimum. And it's going to impact our, kind of societal preferences on a moving forward basis. But this is not a permanent way of life, right? And so,
pardon me for stepping in. We're going to have to drop and wrap up here. But I appreciate everybody's input. I'm getting a signal saying, but so we are going to have to exit. If anybody does have additional questions, I think you can contact each one of the panelists and ask the question specifically. I appreciate it. Thank you for the opportunity. I appreciate your input, guys. Thank you.
Thank you.
Have a good one.
Bye-bye.
Thank you very much, Kevin. Sorry I had to be the bad guy and step in there. I'm afraid we're very short on time, but that was a really interesting discussion. So thank you all speakers for your participation. I know a lot of people remain very excited about the build for rent space. So for the audience, please be sure to fill in an evaluation for this session in Hub. It's just a few quick questions. It won't take long at all. And we now have a virtual networking break with 4 roundtable discussions offering a less formal mode of networking and learning. You can find topic information and access links for these in the login luncheon entry in our session schedule. And then immediately following the networking break at 1:10 p.m. Eastern, we have our SFR owners C-suite plenary discussion on navigating the crisis and looking ahead to the future. So we look forward to seeing you all there, and thank you all again.